Welcome back, or welcome for the first time to our fourth segment in this Ardenwood Presents 6-month webinar series called The Timeless Impact of Planned Blessings, Legacy Planning for short. I'm John Mitchell, and I serve as Executive Director and CEO of Ardenwood here in San Francisco. And thank you for joining us today. By this time, you know just how important legacy planning is. I want to remind you of the wordplay or acrostic I did with plan. It's prayerful listening, acting now. And it's the acting now part that we can all use more of. Without a plan, a considerable portion of one's estate will go to the government instead of to loved ones and the charities or important causes of your choice. No one wants that, yet more than 50% of Americans do not have a plan, or a will, or a trust. Ardenwood is one of the charitable nonprofits organization you might include as a beneficiary in your estate. Donors are invaluable to our work here. Your contributions enable us to provide our care services as well as events like this one. You bring out the best in us, and we thank you. We hope today's webinar and those to follow in November and December, along with your question and answer opportunities, answer many of your questions and generate more. We are always happy to answer them. Finally, the content shared today is only informational and is not intended to be legal advice. A replay of this presentation will be available on our website tomorrow morning. And now, let me reintroduce Jim Maher and Rick Bailey. Jim is a certified senior advisor and a broker consultant specializing in Medicare. He's been helping individuals and companies navigate Medicare since 1989. Jim is also a certified long-term care insurance strategist. Jim and his wife of 35 years, Teddy, live in Lincoln, California, just north by northeast of Sacramento. Jim has talked to well over 1,000 and more Christian Scientists since we first began our webinar just last year, Jim. I can't believe it. It's been a year already. Answering innumerable questions about his Medicare, long-term insurance, and estate planning. Jim's been a tremendous blessing to our field. From what he's told me so far, he has loved meeting and working with all of you. Rick Bailey is the founder and chairman of CAMAS, one of the most highly renowned estate planners in the United States. As a certified financial planner, or CFP, with a master's degree in accountancy and taxation, as well as a Juris Doctorate, or JD, Rick Bailey is a highly valuable asset to private clients, CPAs, attorneys, financial advisors, and life insurance professionals for his expertise in advanced estate planning and case design. Before we begin, let me remind you that we can submit questions using the Q&A icon at the bottom of your Zoom screen. We will answer them on Thursday during our Q&A session. Please join me now in welcoming Jim Maher and Rick Bailey.
Thank you, John. And we appreciate being here. I think this is one of the things Jim and I enjoy doing, is to be able to, work with individuals and help them in their planning. And I really am looking forward to today's topic, because charitable planning, and especially charitable remainder trust, are such a powerful topic for us to be working on. And so what we want to go through today is really, we want to make this as simple as possible, because a lot of times the planning can get overcomplicated. And when it gets overcomplicated, sometimes good opportunities get missed. So as we talk through today, we want to look at, what you're going to learn. And the first thing is, we want to talk about how charitable giving can increase income to you during your life. So this isn't just about planning for the charity. This is planning for you and your beneficiaries or loved ones. And of course, your favorite charity, if that fits into your planning. Of course, charitable planning is a big income tax, strategy. So we use that a lot, just for income tax planning, but it works hand in hand with those that are charitably inclined. We want to talk about how charitable giving can help you avoid high income tax years. So as you look to transition your business, your investments, and create that income that you need during your retirement years, charitable planning can be a big asset for you and a good strategy to use. And finally, how charitable planning can be a win-win strategy for both you and your heirs, and of course, your favorite charity. As we've talked about before, all of this planning really comes down to it's based on your goals. So none of this planning should be or is cookie cutter. And we want to make sure that we understand your goals, what you're trying to accomplish, so that the plan fits you. And if I have people ask, well, what's the best plan? And if you ask me what the best plan is, I'll pull out mine and show it to you, because that's the best one for me. Now, it may not be the best one for you, and we want to make sure that whatever we do fits exactly what you're looking for. When we get into charitable planning, the question is, who's charitable planning for? Of course, it's for those that are charitably inclined, and a lot of people are charitably inclined. They want to benefit the charities that they're involved with. And I usually find that as people get older or mature, especially in their business, it's one where they become more and more charitably inclined, wanting to help the causes that are around them. Like I said, charitable planning also is a great income tax reduction strategy. And of course, an estate tax reduction strategy. All of these get us in the exact same spot, benefiting the charity, benefiting you, and really helping the community that we're involved in. And the reason that we have these great tools to work with, Congress knows charities do such a big part of the, benefiting and helping of those that are in need, helping the community. And so they've structured the tax code really to benefit both you and the charity and encourage more charitable planning. If you look at charitable planning, when can you give to charity? Of course, we can do it now. And a lot of charities need your money now to, handle their operations. It's one where, charities can't operate without your help. And so giving to them now is great. Giving in the future. So for some people, it may not be the best time to make a big gift. But as you sell off maybe some investments, sell your business, retire, maybe that's the right time. And of course, I work with a lot of people that put their charitable giving inside of their estate plan. So when they pass away, that's when they give to the charity. What's the best answer? All of them work. Whatever fits for you and when you want to give that to charity, all of it can be a blessing for those around you, and especially for those that the charity can help. If we look at our charitable giving opportunities, if you're going to give, to charity during life, you can pull out your checkbook and write a check. You can name the charity as an asset, a beneficiary of an asset or an investment account. Pass that to them now and see how they do with the money that you can give them. Of course, if we can do that at death, so you can make them a beneficiary of your estate plan. You can also make them a beneficiary of a life insurance policy. All of that, there again, can be great for the charity and great for you and your charitable giving. What we're going to spend today talking about is Charitable Remainder Trust. And Charitable Remainder Trust, and then next month we'll talk about Charitable Lead Trust, are ways that we can enhance our giving opportunities and still take care of you in your retirement years. So if we look at that as we start moving into charitable trust, I want to take a step back and just say, why do we use charitable trust? And a lot of these issues that come up is a lot of clients that I work with have appreciated assets. And we know since 2008, a lot of assets, of course, they took a beating in 2008. And since then, real estate has gone up. The stock market has gone up. as these assets appreciate, we have to deal with taxes. If we want to reposition those assets, sell those assets, I work with a lot of clients that bought rental homes, and they've been maintaining those rental homes for 30, 40, 50 years. And all of a sudden it's time for them to take a step back. They're not, able to take care of the property, but they don't want to pay the tax if they sell that rental property. So here's where, charitable trusts will step in, and we'll get into more detail there. Do you need income during your life? If we're building up those assets, preparing for retirement, and so you've invested in the stock market, you've invested in real estate. Now it comes time to reposition those assets from an asset to income. Well, anytime we reposition the asset, going from asset to income, Uncle Sam's going to have their hand out for their share of the taxes. So that may stop some people from creating the retirement income that they need. Finally, do you want your assets to go to your heirs? This is where charitable planning can help us in passing more to our kids. At the same time, we're passing more to our favorite charities and issues that we're concerned about. And the nice part of that is less going into taxes to Uncle Sam. So it creates great opportunities using charitable trusts. Now, what I want you to get a picture as we're starting to talk about the Charitable Remainder Trust. Think about the assets that we're talking about. If we're talking about rental property, real estate, land, all of those types of assets that you may have invested in that now we're ready to make a change. It's time to sell that asset to create the income or reposition into other assets. Businesses. And this is one that we've got an incredible amount of businesses being turned over now as the baby boomers hit retirement years. As that happens, how do you take a step back from your business? I watched my dad go through this. It was he went to the same office for over 40 years. Went there pretty much 8 to 5. Great business. He enjoyed going there, but he got to the point where it was starting to affect him. It was time for him to take a step back. How do you get out of that? How do you sell that business in a more tax efficient manner so that you can have the retirement that you need? And finally, your investments. And we don't think about this sometimes, but because we hear a lot about, well, you can reposition your investments. You can sell your stock portfolio and buy other stocks, buy mutual funds. There's a cost to do that. And so sometimes that cost creates a problem for us to where it's tax prohibitive, or at least in our mind, it's tax prohibitive. So instead of making the changes that we probably should make, we drag it out because we don't want to pay the taxes. So have these assets in mind as we go through the Charitable Remainder Trust, so you can see, does this have a position or a part in your estate plan? So if we start looking at the Charitable Remainder Trust, with the Charitable Remainder Trust, the big issue that we're going to look at is, first, why use the strategy? Why are we even talking about Charitable Remainder Trust? There again, it's if you were to sell your property, sell your investments, sell your business, it's going to trigger a large taxable event. And I've been working with clients in high tax states like California, New York, and they have to swallow really hard because of the tax bill that's going to come. There again, is that going to prevent you from doing what you need to do? Do you want to avoid paying a large current year income tax? And that's what happens a lot of these times, where we're going along, we have salaries, we have investment income. It's a pretty steady ride in what we're paying in taxes. All of a sudden, that large tax event comes up, that large year, And so for a lot of people, that's higher marginal tax rates. And there again, is that going to stop us? You're at the point where you want to receive lifetime income. We're exchanging those assets that you have for the income that you need for retirement. And that can be for yourself, or you can set it up for other beneficiaries, your kids or grandkids, however you want to structure that. And we'll talk that through. And finally, you want to provide a large benefit to a charity. And I've got that word large in there for a reason, and you'll see why we have that in there. Because again, this is win-win planning. We're going to make sure it's appropriate for you and takes care of you and your needs. We're also going to be able to set up a large gift at your death for the charity that you want to benefit. So if we go through this, let's talk the mechanics. We've got to talk through how this sets up, because for some of you, this may be the first time that you've ever heard of Charitable Remainder Trust. And for many of you, this is the first time that you've seen how it works. So we'll walk through each step here. So when I talk the donor, it can be you individually. It could be you and a spouse. There's advantages sometimes to having one person versus two. There again, we'll work through the calculations to figure out what's best for you. To start this off, you're going to set up a charitable trust. This charitable trust is designed for you. The only person that's going to benefit from this during your life is you. And so this charitable trust, any terms that we put into this trust are specific to you and your planning. Once we have the trust set up, we can transfer the property, that property that you're ready to get rid of, and we can transfer that property into the charitable trust. Once it's inside the trust now can sell that property tax-free. And then that trust can reinvest those proceeds inside the trust, however the trustee determines. And here's the nice part of it. The trustee of this trust, the person that's in charge of this trust, can be you. That doesn't have to be, but most of the clients that I work with, they want to be the trustee of their own trust. They want to control the investments. I just talked to a couple this morning, and as we talked it through, they were excited that they get to control the investments. They also asked, do they have to sell all that property in there immediately? And their concern was they were transferring in some stock. It's a stock position that they have a lot of stock of that one company. And so we've been talking about it's a great way for them to divest and get a little bit more exposure to other companies. But they said, do we have to sell it all at once? And I said, that depends. You're the trustee. How quickly do you want to sell it? And so we can put the property in and hold on to it for a year, 5 years, 10 years. When it makes sense to sell it is when you make that decision. But once we decide to sell it, you get to do that tax-free. When we set up the trust, you're going to name a charity. And that can be a charity. It can be a charities. So it can be as many charities as you want to name there. You can make that designation revocable or irrevocable, which means, and most I would say, I encourage them to make a revocable designation there so that charity, if your charitable intent changes, if you want to give it to more charities because over time you've been involved in more causes, it just gives you flexibility to decide what fits you. And I find if you've got a long history with a charity, that can be an irrevocable designation. There again, it's whatever fits your planning and what makes you feel comfortable. Once we've done all of this, we're going to generate a charitable deduction. That charitable deduction, it can be used on the current tax return. And if it's big enough that you can't use it all up in one tax return, you can actually roll it over to 5 more tax returns. So we get 6 years to use that charitable deduction. for most clients I work with, we usually use up that deduction in the first 1 to 3 years, but we'll make sure that it gets used up and fits into your planning. One of the things now that you're going to be able to generate here is a set annual payment back from you to the trust, from you from the trust. Now, what we're going to do, and you'll see there it says annuity stream of blank percent. Well, that blank is one of the variables that you're going to have to decide. Do you want 5%, 6%, 10%? It's just one. There are some limitations on how high that percent can go, but we can set that up now so that that payment stream comes out to you. It can be monthly, quarterly, semi-annual, or annual. Most of the time I'll say, probably set it up annual to keep it simple. But we can set that up to last for your lifetime. Or if you're married, can be for joint lifetime. Or we can just say for the next 10 years, whatever you want it to be, this fits into your planning. And we'll talk and show you some examples here in a minute of what having a certain percentage, how that affects everything. Finally, at the end of the trust term, or really for most people at the time they pass away, whatever's left in the trust goes to the charity. So that's where we get the Charitable Remainder Trust name. So when you've passed on, whatever's left in that charitable trust goes to the charity. So if you put $1 million into the trust and it's grown to $5 million, the trust or the charity gets $5 million. They just, have their bucket out, and whatever falls in the bucket, that's theirs. And so there again, we play with this back and forth with the variables to make sure it fits, making sure you've got the income that you want. We've created the charitable deduction that you want. And there again, whatever's left is going to go to the charity. And let's stop here. Let's stop and think about what we're creating here. We're creating great retirement income for you. And we're creating a great opportunity for you to pass, a large amount of benefit to the charity. So it's a great opportunity for you to check off a lot of boxes in your planning. Now, let me tell you, there's a couple things that we have to be aware of here. Number one, if any of that property that we're transferring into the trust, we have to transfer it in before there's an agreement to sell the asset. And two, there can't be any debt on that property. So for investments, this usually isn't an issue. For rental property, real estate, land, businesses, we've got to make sure that before you sign a sales agreement, that we've transferred that property into the trust. Number two, if you have a mortgage on that property, we've got to take that mortgage off before we put it in the charitable trust. If we do, we violated the terms of the charitable trust. And so, we'll work with you, we'll work with your lenders, and we'll see if we can't come up with a good solution. Some of the times what we've been able to do is move the mortgage, from all of the property to maybe a half or quarter of the property with the permission of the lender, of course. But the lender knows they're going to get paid off soon. So in most cases, they know what we're trying to accomplish. And I found most lenders are really good to work with on this. So let's recap this. I want you to remember that the asset has to go into the trust before we make any changes. The trust can now sell those assets tax-free and reinvest those in other investments. The benefits that I want you to remember are, first, this can create lifetime income for you. It's going to create a large income tax deduction for you. And finally, at death, the charity gets the remainder. So there again, those are all three good things that can come out of this planning. We just have to make sure it fits for you and what you're trying to accomplish. So if you look, let's go through a sample case here, because I always find that the cases are what helps us remember it, the stories. So let's take a 50-year-old that's going to transfer $1 million rental property to the Charitable Remainder Trust. So when we're looking at this, the fair market value is $1 million, and that's determined as the date we put it into the trust. We're going to figure out what you're going to have to determine. How long do you want this trust to last? And in this case, let's do it for lifetime. So we have a 50-year-old that's going to do this for life. And we've picked out a 6% annuity stream. So that's going to pay back to this individual $60,000 a year, every year for the rest of their life. And that's going to generate a tax deduction of $208,780. Now, that $208,000 deduction. Remember, we've got 6 tax returns that we're going to be able to use that. And the reason we need to have 6 tax returns, there's a limitation. The most we can deduct off your tax return each year is 30% of your adjusted gross income. So whatever that number is, that's the maximum charitable deduction we can take for this kind of planning. So there again, if we've got 6 returns, we want to make sure we use it up. We'll play with the numbers to make sure it fits with what you're trying to accomplish. The other thing we can do here, we can delay these payments. We can decide, when we design this trust, you may say, we've got a 50-year-old here as our sample client. With our 50-year-old, they may say, you know what, I don't want that $60,000 payment to happen until I retire from my job. So let's say they retire at age 60. They're going to take early retirement. Well, for the next 10 years, we can bank those payments. And we bank those payments inside the trust. So when they turn 60 and says, great, I need you to start giving me that income, we're going to be able to distribute the $60,000 per year, plus start making up for that extra $600,000 that we banked over the 10-year period. So it gives us the chance to really, if we do this right, turn the income off and turn it back on. Just turning that spigot whichever way we want that to go. I would say probably three quarters of the trusts that I work with, we just turn the income on. It goes every year. We don't play with it. That other 25%, for whatever reason, they want to delay payments and take it somewhere in the future. Whatever it is, we want to make sure it fits for what you're doing. Remember, this trust is designed for you and your goals. So you're going to decide what those terms are, and we're going to make sure that trust is set up for you. So if you look at this, if we look at some of these decision points, the term of the trust, so we know it can be set for a set number of years, or we can set it up, for your lifetime. Well, the longer the trust term goes, so the younger your age, the longer the trust payout's going to be, it's going to affect our charitable deduction. So if you are older and we have a shorter time frame, our charitable deduction is going to increase. So let's look at that. So let's go back to our sample case here. If our 50-year-old is doing this, it's 6%, so $60,000 a year, and we've got a charitable deduction of $208,000. Now, if we increase this and change our sample client from 50 to 60, all other provisions of the term are going to be the same. We've now increased our deduction to $320,000. So just by changing that 10 years, and this 10 years, when we calculate this, and people will ask how we come up with these calculations, these are determined by the IRS. So we're using their calculator, their life expectancy tables. So somebody that's 10 years older, they expect to have 10 years left of life expectancy. So we're going to get a higher deduction because the IRS assumes they're not going to live that 10 extra years. Same client, but age 70, now we've increased that deduction up to $464,000. So you can see there again, the older we get, the bigger the tax deduction. Doesn't matter, doesn't affect how long the trust payout is. Let's go back and say our 50-year-old, sets this trust up, takes the $208,000 deduction, and only lives one more year. Well, we still got the $208,000 deduction, but that trust in actuality only lasted a year. Whereas I could take my 70-year-old client, get my $464,000 deduction, and they live for the next 30 years. So when we calculate the deduction, that's based off the IRS's calculations. When whatever happens in reality, we don't have to give the money back to the IRS. It's set in stone when we set this trust up originally. One of your other variables that you're going to be deciding on is, what is the annuity payout? What's that percentage payout? Remember back to our sample case, I set it at 6%. That is just random, pulled off the top of my head. So I know what some numbers look like, and I know what we're trying to accomplish, so I can give it a good guess usually. But as our annuity payment goes down, as our percentage payment goes down, our charitable deduction will increase. So if you think about that, we're taking less money over the annual payments. We're going to give potentially more to charity, so we get a bigger deduction. So let's look at how that's going to play out. So if we take our 50-year-old client here, we've got the 6% payout each year, so $60,000 a year. That's going to pay out $208,000 per year. Or I take that back. We get a $208,000 charitable deduction. If we take our client and put them as, same thing, age 60, at 7%, they're going to get a charitable deduction of $273,000. And of course, now if we raise that to 8%, that increases that even more. And of course, now that I see my calculations, that's, changed backwards. So I put those in wrong. It's $234,000 for the 6% and $320,000 for the 8%. So those basically the lower the percentage, the higher the charitable deduction. The younger our client, the lower the charitable deduction. So we'll always play with those to see what works best for you, what you're trying to accomplish. I have some clients that I'll work with that they want to give more to charity. They don't need as much income. So we can put more towards charity, less towards the income. I have some clients that say we need to have that income for retirement, and we're just giving it to charity with whatever's left. Both of them work. Both of them are great ideas. It's really trying to figure out what's best for you. Now, as we come through this, one part of the planning that really usually comes up, what about our kids? So if we came in and we just gave $1 million to the charity, into the charitable trust, and whatever's left in that charitable trust is going to be distributed out to the charity, what happens to our kids? We want to make sure that they're taken care of. We want to make sure that they're going to get something from our estate. And so can we provide them a benefit in this planning? And the answer is yes. This is one of those times where life insurance makes sense. Life insurance can be used to replace that asset. And so if we've moved $1 million of asset into the charitable trust. Let's just for ease say that we want to give $1 million in death benefit from a life insurance policy to our kids. In this case, we can set up an irrevocable life insurance trust. You can gift or loan money to the trust. And a lot of times people will ask, well, how do I pay for that? Well, we've just, in many cases, increased your income. So that creates some potential liquidity for you. We've just created, a big tax deduction that could, is going to, eliminate taxes that you would have been paying to Uncle Sam over the next 1 to 6 years. So can we use some of that tax savings and some of that increased liquidity to help pay for the life insurance? There again, we'll work with you to see, one, do we need the life insurance for the kids? And two, what's the best way to pay for it? Once we have the life insurance trust set up, then we buy that policy. If we purchase the life insurance inside the trust, the advantage of that is now it's out away from your creditors. It's outside of your estate for estate tax purposes. And estate taxes are becoming more of an issue. We know we've got some tax laws changes coming here shortly that are going to increase a lot of estate taxes for many people. And so we want to make sure that life insurance policy, if it needs to be, is outside of the estate. In that case, the life insurance policy death benefit pays back to the trust, and the trust now can distribute that to your heirs. What I like of having that inside the trust and distributing to your heirs, if we need to, we can add language onto this distribution to your kids or grandkids of what's important to you. We can add extra language to, encourage them to be charitably inclined, to live a good life, stay away from things that are, you don't want them involved in. The other thing is we can protect that from their creditors. And so having that trust set up not only gets it out of the estate, but when we're passing that on to the kids or the grandkids or whoever it goes to, we can add language into that distribution that's important to you. But the big key here is when that distributes to the kids, it's going to be both income tax-free and estate tax-free. Let me go back over that one again. Let's talk about that asset. Let's say that you had that asset that you were going to pass on. Let's say it's you're part of your business. And instead of using the charitable remainder trust, you just pass the business on to the kids. Well, when that passes on to the kids, that may be subject to estate tax. It may have some income tax problems in it as well. And so the kids don't get the gift free and clear of income and estate taxes. If we set up the life insurance the right way, we can, sell the business through the charitable remainder trust, create that income for you, create that great benefit to the charity, and then use the life insurance and the life insurance trust to pass on what you want to go to the kids, income tax-free and estate tax-free. So it really can generate, a win-win situation for both you, the charity, and the kids. So if you think back on this, if we start going back through the charitable remainder trust and just start, doing a recap, the first thing you have to think about, what property should you use for the charitable remainder trust? And sometimes that's a conversation of, is this the right property, or should we even be thinking about using the charitable remainder trust for this property? It's one of those questions. Happy to talk that through and make sure that if you've got a property in mind, that it's one we can use and one it's going to generate the result that you want. Who do you want to be the trustee? Do you want to have, be your own trustee? Do you want to have the kids be the trustee? Or do you just want a bank trustee or somebody else to step in as a third party and oversee that? It really comes down to, what do you want? Do you want that, to control that during your retirement years? Or do you want to, wash your hands of it, collect checks, and just go golfing or whatever it is that you want to do? And so that's just a choice you get to make. What charity or charities do you want to name? Now, there again, we get to decide who that charity is going to be. And we also get to decide, is it going to be a revocable or an irrevocable designation? There again, there's no right or wrong to it. And this is one where don't feel like you're getting boxed into a corner. We want to make sure that you are comfortable with the decisions you're making. If you're not sure what to do, name the charity and keep it revocable. Then you can make those changes anytime you want. Add more charities, take some charities away. Just really control what your charitable giving is going to be when you pass on. And finally, we want to look at what the annuity percentage is that you're going to need. There again, that comes back to creating the income stream that you need. So if you think about this, I'll use the client I talked to this morning. It's one where they're young, very young in this type of planning, but it's one where they've invested well, had some great opportunities, and now they want to set it up for income for early retirement. And so we backed into that percentage off of what their need was. So we can go start with what's the maximum and run that calculation for you, and then start backing down to what makes sense for you. And finally, how long do you want the trust to last? Do you need this for one lifetime, both you and your spouse's lifetime? Do you just want it set up for 10 years? Whatever that length of the term of the trust is really going to be based off of your planning. What do you want to have happen? And so as you really come into that, all of these decisions are a big part of your plan, and making sure that everything that we do from the Charitable Remainder Trust really does benefit you and how you're going to live in your retirement years, what charities you're going to benefit, what good you can do for those around you. So you're going to, as you have questions, feel free to reach out to us. Let us know what questions you have, and we'd be happy to walk through and run the calculations to show you what benefit it could be for you. So I appreciate everybody being on today.
Rick, thank you for explaining Charitable Remainder Trust so clearly. There's a lot going on there and a real benefit. And thank you, one and all, again, for joining us today. We look forward to seeing you this Thursday afternoon for the Q&A session. Same time, same Zoom link. You'll receive a reminder. And we hope to see you next month to address another aspect of legacy planning, which is charitable lead trusts. It'll be on Tuesday, November 16th, with question and answers on Thursday, November 18th. And finally, please mark your calendars for our online-only Christmas celebration titled Sing for the King on Sunday, December 5th at 2 p.m. Pacific. We hope you'll share this invitation with family and friends, and maybe even watch together. Details will be posted shortly on our website and mailed and emailed to you directly. So thank you again, and goodbye for now.